For our Did You Know segment today, we are going to talk about home equity loans versus HELOCs. So we spent the past 2 weeks talking about home equity loans, and then we talked about HELOCs last week. So today, we're going to do a comparative analysis of both. So again, we're going to do a quick refresher because it's been 2 weeks. So home equity loans, lump sum at closing. You get all the money at closing. You have a fixed rate for the life of the loan. The life of the loan meaning your term, and that term could be anywhere from 5 years all the way out to 30 years. Your monthly payments are fixed and what we call fully amortizing. That means every payment you make has a portion that's going toward interest and a portion that's going toward principal. And then by the end of that loan term, the mortgage is fully paid off. The borrowing limit on this varies customarily. We're in the 80% to 85% of current home value range, but I can speak to a few of the relationships we have here at Rate. Some of our investors will go up further than that. The only caution is the higher up you go in that loan to value, the more access of equity that you explore, the higher your interest rate is going to be. So please do bear that in mind. This is best for one-time expenses, where you need a lump sum for debt consolidation or to do property improvements, things like that. And homeowners normally prefer this because you have a consistency of payments and predictability in your payments. Home equity lines of credit, for the quick refresher, is a revolving line of credit. Think like a credit card. It just happens to be secured. Your credit card is what we call unsecured debt because it's not tied to any asset. But a home equity line of credit is tied to the asset of your property, and it operates similar to a credit card. The interest rates are variable on these, although there are some programs available for HELOCs that are fixed. Again, speaking to what we offer at Rate, we offer a proprietary HELOC that is fixed. The payment structure is typically interest only. So a traditional HELOC means that you're only paying interest on the money that you've borrowed from your line of credit. And if you pay that down, your interest payment reduces because you're only paying interest on what you've borrowed. Principal and interest payments normally kick in after your draw period. And the draw period customarily is the first 10 years of the HELOC. So in the first 10 years of the HELOC, it's interest only. You draw from it and repay freely with your minimum monthly payment that you're obligated on is just interest. Once you reach the expiration of that 10-year draw period, or if it's shorter based on your lender, then you go into repayment. And then the repayment turns into a 5, 10, 15, 20 year, sometimes even 30-year mortgage, and you will have a fully amortizing payment like your home equity. You can kind of think of it like if you know you need your money right now for something, you take out a home equity loan. If you're like, I may need money, we're kicking around the idea of some home improvement, but we're not sure about it yet, then a HELOC's the right choice. And you get that set up because essentially the HELOC will turn into what that home equity mortgage looks like after you've settled up what you're going to need, you've taken out what you need, and you go into the repayment phase. It's also really good for ongoing expenses. So when you have a HELOC, if you know that, every year we're going to have this bigger expense that I like to have spread out, it's a great tool for managing that. And it's best for homeowners that are comfortable with varying payments. We talk about the interest rates on a weekly basis. They change on a weekly basis. Because HELOCs have adjustable rates, it means your interest payment could adjust month over month. So that's something to be considerate of. If you're comfortable with it, then you're good to go. So now we're just going to do a side-by-side comparison, one versus the other. So we're going to compare home equity loans, those are the fixed rate, fully amortizing, to HELOCs. We're going to start off with the interest rates. Starting off with interest rates, and you know what? I'm going to throw up a graphic over here. So for those who are not just listening, but watching on YouTube, I got a graphic up for you. So starting off, home equity loans. Interest rates. Home equity loans, fixed rate, fully amortizing. HELOCs, adjustable for the draw period, and then goes, and normally it fluctuates with the Wall Street Journal prime rate. That's the most commonly used market index. When you have an adjustable mortgage in any sense, that adjustable rate mortgage is tied to a market indicator. The market indicator most commonly used for HELOCs, Wall Street Journal prime. Next up, payment type. Home equity loan, fixed monthly payments, fully amortizing, principal and interest in every payment. HELOCs, interest only for the draw period, customarily 10 years, and then it's variable later when you go into repayment. You could still have a variable rate even when you have the fully amortizing 5, 10, 15, 20-year loan when you're in repayment phase. Access to funds, home equity loan, lump sum at closing, cash in the bank for you to manage, and you have your monthly payment. Home equity lines of credit, HELOCs, flexibility. You could take out as much at closing as you like or leave some line open and available, like on a credit card, and then draw from it when you need the funds. Best for. I like this category. What are these best for? Home equity loans. We touched upon this before, but to recap, home equity loans are perfect for one-time expenses. If it's a one-time renovation you're doing on your property, if it's debt consolidation to consolidate the credit card debt that may have run up over the past couple of years, great option, fixed rate, fixed monthly payments. HELOCs, ongoing expenses. If you have future funding needs and you don't have an immediate need, setting up a HELOC works great. The caveat here that I'll share for HELOCs, I said this last week, but I want to highlight again. HELOCs are great and best suited to be obtained when you don't need them. So when you don't need the HELOC, that's the best time to get it. So remember that. Get the HELOC, have it established, especially if you have anticipation in the next 6 to 12 months that you're going to have a cash need. Great thing to do. There's no pressure, no timeline, no deadline on you. Now the risks. So on home equity loans, there's not a lot of risk compared to HELOCs. You have a fixed rate. You have a fixed monthly payment. That automatically, categorically, side by side, creates way less risk for you. The risk that is inherent there, though, is if you overextend your credit again after paying off credit cards, if you used it for debt consolidation purposes, and then you start having issues paying back that mortgage. When that mortgage goes into foreclosure or goes into default, it could create foreclosure, and that's a problem. So that is the risk there. So if you're going to use it for debt consolidation purposes, change your financial plan. Whatever you were doing before, don't do the same thing now. If you're tapping into your home equity to consolidate your debt, a behavioral change is required as well. Just some fun-friendly advice. HELOCs, a little bit more risky. There's adjustable payments and adjustable rates involved. So it is a riskier one that comes with the benefit of more flexibility, but bear that in mind. If you can't tolerate the risk of interest rates moving and that monthly payment possibly going up, going down is nice, but the risk side is if it goes up, bear that in mind. And you can possibly mitigate some of that risk by prudently drawing and repaying, but side by side, I want to at least highlight the risks of both of those. Lastly, I want to talk tax deductibility. I'm not an accountant, so I would defer you to your tax professional. But if you are going to use the funds from a home equity mortgage or a HELOC for home improvement purposes, you may have a tax deductibility aspect available for your interest rate. Talk to your accountant about that. That could be something that's beneficial to you as well. So in summary, I think we did a good job of covering our bases here for HELOCs versus home equity mortgages. Lump sum versus line of credit, draw from, treat it like a credit card. In both of these cases, I want to highlight this. If you're going to use this for debt consolidation in either case, make sure you're talking to a financial advisor or financial professional to rein in your financial plan, because I see it happen all too often where these loans get leveraged and it provides relief. And then a year or two later, oh, I need to do another one, or I need to tap into more home equity. And that's not good. And I just want to be looking out for you here. Make sure that if you're going to pursue this type of financing, that a game plan is implemented to make spending habit behavioral changes and budgeting changes so that you don't risk falling behind possibly in the future on this new mortgage, or falling behind on your other credit cards if those debts start to run up again.